Hello, everyone. This is Dr. Duru with Ahan Analytics and the market breadth. All right, let's dive right into this. We have the potential for a government shutdown on October 1st. That's 5 days from now. It's September 26th. It's after about 2.5 hours after market close on a Friday afternoon. Now, this headline caught my eye because it kind of matches my own sentiment. And as I will show, the market completely is ignoring this and doesn't seem to care and is not pricing in the odds of a government shutdown whatsoever. The key paragraph here comes right at the top, so they didn't bury the lead. Right here, they says, and why things may be more likely to end in a shutdown is simple. Not only are both parties okay with a funding stoppage, but partisans even view the idea of going through with it as an opportunity or political necessity. So this is a pretty solid setup for a government shutdown. Of course, everything could flip on a dime with no shutdown because we've seen this drama unfold before, but it's still amazing to me. Yes, we've all seen this story over again, but this time does seem different, at least different in terms of the odds being higher, even if the outcome is the same. And all I have to do is take a look at the VIX. So I'm going to the charts now. The volatility index, the VIX, dropped 8.6% today. And that's going into a weekend where, on the other end of the weekend, our lawmakers have literally just 48 hours to make up their minds as to what they're going to do about this the debt ceiling. So anyway, so with the VIX falling below 15, sorry, falling 8.6%, of course, the VIX is staying within this extended trading range and it's still below where it was right before all the tariff drama, trauma, and noise started. The overall message from the market is complacency, see no risk, hear no risk, smell no risk, taste no risk. Government shutdown, nah, no problem. It'll all be fine. So that's what we have to go with as traders and investors. We go with what the market's saying. But of course, I'm still, my short-term trading call is still neutral. So because of that, yes, while I want to follow the existing trends, I'm still very wary of the downside risks. And to me, the downside risks are very real. And with the VIX so low, it means that buying protection is very cheap. Okay, now, I titled this Market Breadth is Waning or Wobbling into this government shutdown risk. And this is a good example of why. You can see my favorite technical indicator, the percentage stocks trading above their 50-day moving averages, what I like to call AT50. This is a measure of market breadth because it says how many stocks, what percentage of all the stocks stock market are above an important trend line. So the 50-day moving average measures the average price over the last 50 days. And that's what AT50 says. You can see here it's now taken on this slight downtrend. And on Thursday, it jumped down a lot. What was this? It fell from about 60% all the way down to 55%. And then today it had a nice little bump up. But I'm very wary because overall this trend is down. Back when I talked about this big surge, gosh, it's almost a month ago. Actually, it was over a month ago. Market breadth hasn't made any further advance. And that also worries me because this is all underneath the overbought level, which is 70%. And I write a lot about this. I won't go into the technical details of this, but the longer market breadth stays below this 70% level, overbought, the more worried I get. Now, of course, this could all resolve to the upside, but this is why my short-term trading call is neutral because I see increasing risks in the market day by day and week by week. Now, if I go to the percentage of stocks trading above their 200-day moving averages, the picture is actually, fortunately, a lot better. It is also in a trading range, but there is no downtrend in this market breadth indicator and is just bouncing around. So the odds are, 50-50. We could get a breakout and the market will be just fine and even healthier than ever, or we get a breakdown that confirms my concerns about the shorter term 50-day moving average market breadth indicator. All right, let's jump into the major indices. Those are what we want to observe as our outcome. You could see now, those of you who don't believe in technicals, I talk a lot about technicals because they matter over and over and over again. whether it's humans that believe in it or whether it's humans that have programmed their robots and their trading algorithms to believe in it, over and over and over again, we see why it matters in the short term. And here we have the S&P 500 dipped on Thursday. And look at this. Let's see if I could zoom in. Yep, I could zoom in. Picture perfect test of the 20-day moving average line, which is this dotted line. So again, remember, daily moving average means this is the average price over the last 20 days. And the S&P 500 sold right down to that line and mechanically, automatically, automagically, whatever you want to say, bounced right back up. And then today we had the follow through buying, which is a 0.6% gain. I mean, you just can't get more picture perfect and poetic in terms of technicals than the S&P 500's behavior last week. You could see it fell from the upper Bollinger Band, which is this black line. I won't go into the technical definitions of it. It just drifted down slowly but surely and neatly tested that line. So if you're bullish, this is a beautiful thing. It means you can just ignore all the risks, just like the rest of the market is. If you're bearish, you're shaking your head and you're saying, what in the world? The market should have broken down right here, and it didn't. The NASDAQ had a um, very similar experience. Now it has less stocks in it than I think it has less stocks in it than the S&P 500. So I don't expect it to behave technically as perfectly as the S&P 500 does, but you can see it still had that nice steady drift, and then suddenly sentiment changed and created this nice rebound on Friday. Let's look at IWM because it also had a picture perfect technical day. You could see IWM, which is the iShares Russell 2000 ETF, the ETF of small caps, also drifted down right to its 20-day moving average. And as you know, I'm trading around a large position in IWM. So I, of course, mechanically, my own brain is programmed. I mechanically bought call options right here on this test of the 20-day moving average. And boom, got this nice little pop 0.9% on Friday. Of course, we'll see what happens with the risk of the government shutdown going into the week. Okay, so those are the indices. The indices painting a picture that's very consistent with the VIX or the volatility index. Nobody cares about risk right now, and all systems are go. All the trends are upwards because of the 20-day moving average and the 50-day moving average. We're all set to point upwards. But of course, once we look at individual stocks, we get into more interesting and varied stories. Here's Apple. Let me pull back a little bit. The big test for Apple is it soared. Suddenly, sentiment has totally flipped on Apple. Everyone's excited about the new iPhone release. It ripped higher 2 days. What was this? Last Friday, it ripped up 3.2%, and then it started this week ripping even higher at 4.3%. But the buyers just suddenly got almost completely exhausted from there and refused to test this all-time high. So this is what I'll be looking at for Apple. Can buyers or are buyers interested in taking Apple to heights that it's never seen before? If not, then of course we have to assume that a some sort of pullback is going to unfold, and we would look at the standard support levels, the 20-day moving average or the 50-day moving average for buyers to get interested all over again. Now Zillow, oh, not XG, Zillow ZG had a bad week this week. It started off with a 6.6% drop and it never recovered. The big news with Zillow is that there was a merger between there was an acquisition of one of their competitors. It's funny, I didn't think of House as a competitor, but I guess they are in housing transactions. I'm forgetting the acquirer. Sorry about that. But anyway, the main point here is that Zillow had been following this nice uptrend here, and I had been riding the stock for a while, and then I saw this move here, which was a classic topping signal, which is a stock that rallies well above the upper Bollinger Band. And how do you know it's above the upper Bollinger Band? Because it's in this big white space and it reversed sharply. And I got nervous. This doesn't work all the time. You could see that Zillow had done this before in the past, and I had just sat through it. But this time was the fourth time that it's done this. And I just said, enough is enough. Let me get out. So I got very lucky. I sold out of my shares. I'm probably not going to get back in Zillow. You can see if I pull back here, this is an important pullback because Zillow essentially failed at a double top that was built over 2024 and 2025. So I need to be, from a technical standpoint, I need to be very careful about Zillow Group Incorporated, ticker symbol ZG. Okay, next up we have Compass. That's the company I was trying to get. Compass is the company that acquired House and caused all this. You can see Compass was punished for this acquisition even more than Zillow was punished. So they got dropped 15.7% as thanks for their efforts. And you could see Compass's timing was also kind of bad from a technical standpoint because the stock had rallied just about back to the highs of this year. You could see again, this big move post earnings was 28.3%, and buyers never, ever got the power or the steam to push this stock any higher. And that was a telltale sign. I mean, of course, we had the tariff drama, trauma, and noise that helped take everything down, but it took a lot of work for this stock to get back to those levels. And now only to have the company acquire, do an acquisition. And now buyers or investors are a little discouraged about the overall merger. But, over time, this stock could easily recover. They'll convince investors in their next earnings that this was a great deal and so on and so forth. But with everything, we'll see. Okay, let's go to Morningstar. Just very quickly, Morningstar does equity research and issues analysis on financial markets. I forgot to cover this last week when I was talking about the threat that investors think is coming because of AI deep research. And Morningstar also has suffered last week. It dropped 6% and it has yet to recover. It's just bouncing around. Let me zoom out to just show again the importance of the downtrend for Morningstar. You could see that it spent a lot of time trying to recover back to its former all-time high. It reached it just barely, and then ever since it failed to hold that new all-time high, it's been in a downtrend. And I'm watching now this whole space very carefully because I'm a big user of AI research, AI deep research. And I find it interesting that people think that the technology is already capable of undermining complete, well-established business models and companies like Morningstar. Remains to be seen. Another thing that has bewildered me is First Solar. I've written about First Solar. They're, of course, a solar panel provider. And I've been amazed at how well it's maintained this uptrend. You could see now that the 20-day moving average and the 50-day moving average are very well behaved, pointing upwards. First Solar is pointing upwards. I've tagged a lot of important events here, and First Solar has sold off just when you would think it would sell off on bad news on the policy front. And all it took was some of these restrictions not being as bad as feared. That was last month. And the stock, pulled back a little bit right to this trend line and just continued higher. So I'm trying to ride this as long as possible. I finally, bought some shares, accumulated shares, sorry. I really thought I would have a chance to buy first stocks like First Solar much cheaper in another year or two. That was my longer term plan, but I felt compelled to just go ahead and jump in now before for whatever reason people are buying this up now. I just don't want to miss the move. But if much lower prices come, I'm very welcome to buy up more. Okay, let's get a little technical. MongoDB, they are the database provider that I thought pretty much was done. Not done, but just wasn't going to be a good investment. You can see how much it's just chopped around for the last, let's just call it 5 years, with a lot of excitement up and down since then. And the last excitement was a massive 38% post-earnings gain. And MDB has impressed me because buyers have stayed the course, and MDB has managed to trade higher since that big post-earnings gap up. Now what we have is what's called a Bollinger Band squeeze. You can see these two black lines have squeezed down on the price action. And what that means is that the stock is transitioning from a high volatility environment to a low volatility environment. So that means the price variability day to day has shrunk significantly. So why is this important? Why is it interesting? Because oftentimes the resolution of this squeeze is a buying or selling signal. So if we get a breakout to new highs above this level, let's say above $342, then that's a buy signal. And most of these, what you'll want to see is that that a resolution of the squeeze is maintained in the direction of the breakout or the breakdown. If it goes below, let's just call it $307 or so, we would expect more selling pressure to the downside. So that's what I'm going to be looking for on MongoDB, ticker symbol MDB. Okay, Alibaba. This is one where technicals actually failed me, and that's why I wanted to bring this up. Um, I did catch some of the move in Alibaba and I got out too early. But where I really failed was that this is just a big time trick. So this looked like Alibaba was topping out. Price action stalled after a long run up, and you could see all of these fades from intraday highs. And but what really got me is that on this same day that Alibaba finally turned red, I mean, it only lost about 0.7%. Baidu dropped a lot. I think it was like 10, 12% or something like that. Actually, let's just take a quick look. Baidu dropped 8.1%. And so I thought, oh, this entire sector of Chinese tech stocks has topped out and will fall, and Alibaba is just on the cusp of its fall. Instead, it did exactly the opposite, soared 8.2% the next day, gapped up on news that they're going to be buying NVIDIA software. I think there was some other news as well. And it's interesting that we're in this era where stocks now, not only if you just mention AI, you might get a premium, but even more importantly, you can announce that you're spending money on AI and the stock market will give you a higher market cap. That's a truly amazing place to be. I'm old enough to have seen this back in the dot-com bubble. This feels like 1999. Maybe it's 1998. Who knows how early or how late we are in this kind of bubblicious stock market behavior. But regardless, this kind of stuff just gives me flashbacks over and over again. And my lesson here is that if we truly, because in a bubble, it's very hard to call a top or an end. I need to stay extremely disciplined. So if I'm trying to bet on a technical pattern that suggests a topping or a bearish pattern, I need to consider, well, what could go right and trade accordingly. In this case, fortunately, I took very small risks, so this was not a big deal. But the thing is, if I had really thought a little bit more about what had gone into this big up uptrend, I would have considered, well, maybe I want to do a hedge play just in case I'm wrong. So that's kind of the approach that I should be taking more often going forward. Okay, eBay. eBay, those of us from back in the day, we know eBay is being old school. I'm amazed and amazed and over and over again at how they've been able to survive. They made an all-time high back in last month. Now it's back on my radar again because you can see here it's been perfectly following this trend line, the 50-day moving average, which is the red line. I went ahead and bought a call spread just to play a continuation of its rally and a bounce off of this trend line. But today's 2.1% pullback that underperformed the general market makes me think that this trade may not work out because I want to see the stock follow the market at least, and this is a counter move. So I'm a little worried that this trade will not work out. As always, we'll see what happens next week. CarMax. Okay, this one. Okay, I'm not going to read this whole thing here. I hope if you're interested in seeing this analyst note, you can of course hit the pause button and read it. I got this clip from briefing.com and I just kept it here because CarMax completely collapsed post earnings 20, what was this? About 20%. And here's an analyst talking about, oops, this move caught me by surprise. Here's why. Here are the things that could happen in the next 12 to 18 months because they removed their price target as a result of this action. But I do have to say that, for any kind of stock that has a consistent and long-standing downtrend, you have to respect the what the market is trying to tell you. And in this case, let me just pull back here a little bit. CarMax's price action has been awful for quite some time. It topped out in 2021, collapsed, of course, into the bear market. It barely recovered much of its price action after this bear market. It couldn't even finish reversing the last slide into the bear market. And then it started a downtrend from the highs of this year. So everything, the market is just screaming at you. This is a stock to avoid. And so I just point this out because it shows the weakness of fundamental analysis. Sometimes you could do all the research you want to convince yourself that what you're seeing just from price action alone is not real. Now, sometimes it works out, sometimes being a contrarian works out, but you could do all that analysis and maybe wait to act on it until you see the market coming around, showing some kind of sign that it is seeing what you see. There's no, of course, guaranteed formula here. And as always, I'm providing this information for educational purposes. Please invest and trade on your own risk tolerances and timeline. But I just want to make another case for technicals here. And this is a classic example of it where the technicals were warning all along. So anyway, getting off my technical soapbox and let us continue because I have another technical. This was both a technical win and a miss. I've already talked about Intel before. I think it was last week. I talked about the nice big move here. It allowed me to exit my position with a profit. And I also pointed out that I saw this fade in the weakness, and I said, I'm going to watch what happens to Intel when it gets to this natural support line. What is this natural support line? Well, it's the close before the big post-earnings collapse that initiated Intel's long-suffering trading range, a year long. And I said, I'm going to watch to see what happens. And look at this. I mean, this was not quite picture perfect, but it's poetic enough. Intel punctured that support line a little bit here. I bet you some people jumped in short thinking it was about to fill the rest of this gap. But then the next day, Intel gained a little bit and recovered that support line. Now, that's the exact moment that I should have jumped right back in, not just with shares, but with call options. And instead, I did not. Oh, I forgot to put my label here. What happened is the very next day. Oh, sorry. The very next day, Intel gained another 6.4%. No news, but this was the market saying, hey, something is up. Now you have a confirmed bounce from support. So this 6.4% move confirmed support. And sure enough, the next day it was announced that Intel was in talks with Apple. I still don't know whether this has been confirmed, but the two are now in talks. Now, that just shocked me because I know Apple kicked Intel to the curb years ago. I mean, many years ago. So, but regardless, whatever the news was, the price action is really what I just want to focus on here. And I just had to kick myself for missing this because I pointed out the potential technical setup. I took my eye off the ball. I wasn't watching the stock because I just assumed Intel was going to go back into its previous behavior of drifting around for a while, and I missed that. So what's the lesson here? Is stay on top of your technical setups. Regardless of what the news environment says, price action matters up until and maybe up until or unless we're talking about earnings, which earnings, of course, introduces a whole lot of extra uncertainty. All right, IBM. IBM was fascinating. I didn't put labels on this one. IBM is in my AI basket, but I should be keeping it also in my quantum basket. So IBM had a nice pop on Thursday, 5.2% on news that it was in talks with, I think, HSBC, I think, in talks with them or working on a project with them to do quantum bond trading. And I'm thinking, why in the world do you need expensive quantum technology to trade bonds? But regardless, the market loved it. It's like another proof point that quantum is real, particularly in terms of IBM. It's fascinating that the stock pulled back 1.7% ahead of that news. So clearly nobody knew about this, or folks got tired of waiting for the news because you can see IBM was on a very nice uptrend, recovered from its post earnings loss in July of 7.6%. And now it's completely filled that gap. I actually did have a position on IBM, and I'm guilty as being one of those folks that got tired of waiting, and I took profits. I think I took profits, yeah, at the beginning of the week because I was so relieved that the stock gained almost 2% and was starting to fill the gap. Who knew? But anyway, I've finally come around to IBM, so I'm constantly on the lookout for buying opportunities. So I consider IBM, International Business Machines Corporation, ticker symbol IBM, to be a buy on the dips. Okay, we're almost through. Oh, sorry. Of course, I should show what happened in the space. So when IBM made that announcement, stocks like IONQ, which is another quantum stock, dropped 6%. I think it was down as much as 10% on the day. Um, I think this is just selling in sympathy, saying, "Hey, IBM as the big company in the block with good enough, cash flow and financing is perhaps a competitive threat to all these upstart quantum companies." But that remains to be seen. And I'm looking at this as a potential buying opportunity for IonQ, which is I guess I'll make it my second favorite. IBM now is going to be my favorite quantum play. And hopefully it can fall back to about this 20-day moving average, which would be around 58, would be a good point. I would love to be able to get it closer to the 50-day moving average, of course, which would be around $48. Okay, we're almost through. Let's look at Marvel Technology. Had a great technical breakout on Thursday. It's above the 200-day moving average. I haven't talked about that yet in this video. 200-day moving average is the average price over the last 200 days. You can see it's this bluish or purplish line. It has not quite confirmed the breakout with follow-through buying, but I still like the setup. Marvel Technology, ticker symbol MRVL, is bullish once again. This is particularly important because it's more than recovered from its post-earnings loss of 18.6% from last month. I mean, that's essentially a crash. And you can see here that sellers just couldn't press the issue any further. The buying, if you were interested in this kind of stock, the buying signal was as soon as Marvell made its first post earnings high. That's when I like to do these kind of contrarian buys. And you can see that that would have been very profitable. For latecomers like me, I'm now looking at this 200-day moving average and looking at that as the next buy signal. And you can see that it's in an important spot because number one, it finally closed above this last breakout point in July, and number two, it's filling in a gap from a post earnings loss in March that was 20% in size. So Marvell has had some really bad post earnings drops, but if this rally could continue one more close higher, it means that this stock is probably leaving behind motivated sellers and is transitioning into what we like to call going from bearish to bullish reversal and is now attracting motivated buyers. That's a great position for this stock to be in. The one caution I have, of course, I always have caution, is that this is going to be a major hurdle for Marvell to get over, but we'll worry about that for later. Let's just see if Marvell can get back to, say, around 100 based on this move. Okay, so that one's on my buy list and on my radar for next week. Government shutdown or no. Nike has the reverse problem. It broke down below its 200-day moving average. You can see the stock is starting to look very tired. After its 15% post-earnings gain in June, the stock was looking pretty good, and now it's going into next week earnings looking very weak and tired. That doesn't guarantee that the stock's going to sell off post-earnings, but it's just a note of caution. And if I pull back, remember what I said about CarMax. Same thing applies to Nike. The downtrend is significant and meaningful and cannot be ignored. So that means you trade or you invest in Nike accordingly. If you want to get in, you get in when it's at the bottom of the downtrend channel because your downside risks are less. If you decide to get in towards the upper part of this downtrend channel, then you have great risks because if this downtrend just continues, it means that eventually Nike will get back to testing and maybe going lower than its April low. I don't have a fundamental catalyst to explain how that could happen, but that's just what the price action says. So for Nike to provide investors, traders some hope, it really, 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 really needs a good earnings report that not only has good news, but that the market reacts well to as well. So this is going to be on my radar, not for a buy or for a sell, but I just think of this. I like to see how the technicals resolve through the fundamental news of earnings. And of course, this Nike could have some important things to say um, about the health of the retail customer because that's also been in doubt with in terms of the restaurant sector having a lot of sell-offs lately. Okay, silver, great move, almost gone parabolic. I'm just putting this up here to say that there is one part of the market that does care about the government shutdown and all sorts of other government shenanigans and Federal Reserve rate cuts and increasing deficits. That's the precious metals sector. So this is where I go to see, okay, what's really going on with people's thoughts on the risk ahead. Silver soaring, I presume, because of the growing appreciation of those risks in this part of the market. Silver, of course, is also has industrial uses, so you could think of this as a good harbinger of economics. I mean, like even solar panels use silver, so maybe this is saying that solar is also doing well. Who knows? But if you have any other doubt, then gold is the signal. I do have a position in gold, and gold has stayed up. The Federal Reserve cut rates a week and a half ago, and gold wobbled a little bit after that, but it's gotten back into its uptrend. And gold is just something to keep buying on the dips. And that's what I'm trying to do. I haven't been as aggressive as I should have, particularly with this nice breakout. I mean, look at that nice pattern here. I should have gone all in, super aggressive, but I did not. It's just the way it works. I'm not, I do, as you've seen in some of my examples, I don't always execute well, even for the things that seem so obvious by sight. Anyway, that's all I have for today. Remember, the big headline risk is things around the government shutdown. Don't obsess over it. Don't monitor it day to day or anything like that, but just know that that's in the background. October is the last of the three most dangerous months in the stock market. I've written about this as well. You can check out my blog at drduru.com/122 and do a search on most dangerous months, and you'll find that article. But the upside or the upshot of the most dangerous months of the year is that those dips need to be bought. So while I'm warning about the risk of the government shutdown, on the flip side, I'm going to say that if the market actually starts to care about it and does sell off, it's likely going to be a buying opportunity for the next run. I can't guarantee that the market is going to get back to all-time highs too quickly, but the history says that sell-offs, particularly in October, are some kind of bottom on the way to the seasonal strength in the stock market that usually lasts from the bottom of October, whatever bottom we get in October, all the way through at least April. Not a guarantee, but this is just the seasonal pattern that we tend to see, okay? All right. As always, share and like this content so the algorithm knows what's up. Subscribe to this channel if you would like to see more of this kind of content. If you have any comments or suggestions or feedback, put them down below. In the meantime, thanks for checking this out, and I will see you the next time. Take care and be safe out there.